Good morning to all. Today we are going to discuss the topic basics of income tax. And before going directly to the core concepts of income tax, you need to know what is tax. Tax is a compulsory extraction of money from people by competent authority for the common benefit of the society. I repeat, tax is a compulsory extraction of money from people by competent authority for the common benefit of the society. So, tax is a compulsory charge on the income of the people which is levied by some competent authorities like central government, state government and local authorities. And the money collected as tax by the government is utilized for the betterment of the people or betterment of the society, and also for ensuring revenue for the smooth conduct or smooth functioning of the government. And the tax is classified into two, direct tax and indirect taxes. Then what is direct tax? When tax is levied on a person who pays the amount directly to the government, it is called a direct tax. I repeat, when tax is levied on a person who pays the amount directly to the government, it is called a direct tax. Here, in the case of direct tax, the taxpayer himself estimates his tax liability and pays it directly to the government, and there is no intermediary in between the government and the taxpayer in the case of direct tax. And the income tax is the only direct tax in India since 2015, as the wealth tax was abolished in the year 2015. There was another direct tax which was called wealth tax, and it got abolished in the year 2015. And since 2015, there is only one direct tax, that is income tax. Next is indirect tax. Indirect tax is the tax paid by the taxpayer through various intermediaries to the government. I repeat, income tax is the tax paid by the taxpayer through various intermediaries to the government. So, indirect tax is the tax paid by the taxpayer through an intermediary or middleman like traders, manufacturers, and even service providers. And all the indirect taxes like service taxes, state value added taxes, central sales tax, excise duty, all such indirect taxes were merged together, and a single system of taxation called goods and services tax came into existence, or it came into force on 1st July 2017. I shall give you a brief introduction about the Income Tax Act. The Income Tax Act 1961 came into force on 1st April 1962, and the Act extends to the whole of India, including the state of Jammu and Kashmir. And the Income Tax Rules 1962, the Finance Acts passed by the Parliament every year, govern the income tax law in India. And the rate of income tax for a particular financial year is determined by the Finance Acts passed by the Parliament every year. And the collection of income tax is entrusted with the body of Central Board of Direct Taxes on behalf of the central government, which is the apex body of income tax in India. Here I am going to explain some important terms in income tax. The first one is assessment year. Assessment year means a period of 12 months commencing from 1st April every year. I repeat, assessment year means a period of 12 months commencing from 1st April every year. So, assessment year is a period of 12 months commencing on 1st April every year, and it ends on 31st March of the next year. And it is a period of 12 months immediately succeeding the previous year. And the current assessment year is 2020 and 2021, which has commenced on 1st April 2020, and it ends on 31st March 2021. And it is the year in which we are actually paying the tax for the income generated in the previous year or the preceding year of the assessment year. The next is previous year. Previous year means the financial year immediately preceding the assessment year. Previous year means the financial year immediately preceding the assessment year. So, previous year is the year in which the income has been generated, or the year for which we are actually paying the tax. The current previous year is 2019 and 2020, which commenced on 1st April 2019 and ended on 31st March 2019. The current previous year is 2019-2020 and it commenced on 1st April 2019 and it ended on 31 March 2019. The next is, who is an assessee? An assessee is any individual who is liable to pay taxes to the government against any kind of income earned by him for a particular assessment year. I repeat, an assessee is any individual who is liable to pay taxes to the government against any kind of income earned by him for a particular assessment year. Assessee is a person who is liable to pay tax or any other sum of money to the government as per the provisions of the Income Tax Act 1961. A person who is liable to pay tax or any other sum of money to the government by the provisions of the Income Tax Act 1961. Next term is deemed assessee. Then who is a deemed assessee? A person who is bound to pay tax in respect of the income of another person is called a deemed assessee. A person who is bound to pay tax in respect of the income of someone else is called a deemed assessee. For example, the tax payable by the guardian of a minor on the income of that minor person, and the tax payable by the legal representative on the income of a deceased assessee are examples of deemed assessee. Next term is assessee in default. When a person liable to comply with the legal requirements under the Act fails to do so, he becomes an assessee in default. I repeat, when a person liable to comply with the legal requirements under the Act fails to do so, he becomes an assessee in default. That is, when a person fails to fulfill the legal requirements in connection with the income tax matters, he becomes an assessee in default. Or an assessee in default is a person who has failed to fulfill the statutory obligations under the Income Tax Act. Example, failure to pay advance tax. That is, when a person who is bound to pay advance tax has failed to pay the advance tax, he becomes an assessee in default, or he can be termed as an assessee in default. Another term is accelerated assessment. Every assessee is liable to pay tax during the assessment year for the income earned during the previous year. However, under certain circumstances, an assessee will be assessed during the previous year itself. This is called accelerated assessment. That is, there are situations where the assessee is bound to pay tax in the previous year itself. Such assessment made in the previous year itself is called accelerated assessment. And these are the various situations under which such accelerated assessment is made. First one, income of a non-resident from shipping business and income of a person living in India. If the income tax assessing officer has sufficient reasons to believe that that person may leave India soon, he may ask the person to pay the tax in the previous year itself instead of paying it in the assessment year. Then income of association of persons, body of individuals, artificial person may also be he asked to pay income tax in the previous year itself. Then discontinuance of business or profession. If the income tax officer may have sufficient reason to believe that this business may be closed in the near future, he may ask the business or profession to pay the income tax in the previous year itself. Then next is transfer of property to avoid tax. Here in this case also, if the income tax officer is having evidence regarding the transfer of property only for the purpose of avoiding the tax, he may ask the property owner to pay the tax in the previous year itself. Next is residential status and incidence of tax. There is